Now, global growth could fall to levels last seen during the 2008 financial crash and the COVID pandemic if there is a prolonged war in the Middle East. That's the stark warning from the Organization for Economic Cooperation and Development. The OECD has cut its growth forecast for this year to 2.8% and warned that if the conflict continues into 2027, global growth could slow to as little as 1.8%. Asian economies that depend on crude oil, fuel and natural gas from the Gulf are expected to be the hardest hit. Joining me now is the head of international at KraneShares, Xiaolin Chen. Thanks so much for your time. You know, given this uncertainty, the OECD has got two scenarios. One is an end to the conflict quite soon. Another is prolonged disruption into next year. Which one do you think we are currently closer to?
It is thank you, Sally, for having me on your program. It is very hard to predict exactly the geopolitical risk at this moment. One day we could have an agreement on the table. One day we could learn from the media that could be a breakdown in the negotiation and discussion. I think the market initially react to this geopolitical risk quite in a shock way because they didn't expect it to happen. So market repressed quite sharply. If you remember, they sell off quite sharply. Then they rebounded, stabilized. Now I think market take a bit of like, you know what, take a break and then see what is happening next. Seems to absorb a lot of the volatility, the immediate shock quite well at this point of time. But again, if any significant breakdown of negotiation and agreements between U.S. and Middle East, this could be another shock of, volatility come to market.
How many months do you think we've got before we start seeing countries tip into recession territory?
This is a great question. I think for countries particularly more sensitive to energy and oil storage, so on and so forth, namely in Europe, namely in UK, are at the very much of the front line. In a very awkward situation with very high oil price, high cost, very dumping demand, households start to feel the bills to come in higher energy bills again. Inflation going to be, show numbers in the coming months that is elevated. And at the same time, the growth is start to show very sign of weakness. This is going to be, I think, impact probably European countries. Most likely, Asian obviously will get impacted too, but some of the countries can, absorb some of the shocks from the neighborhood, from locally, but the whole economy globally will get impacted one way or the other.
Yeah, absolutely. How do you see China faring?
China actually China will not be immune from the situation. That is clear to the market. But China has two or three other toolkits in their hands, actually position them better or slightly better, relatively speaking, to their counterparts, globally speaking. One, namely, they have a slightly higher reserve in the oil. So they do have hundreds of, no one knows the exact date, but the market expectation was hundreds, nearly to 200 days of reserve they have. So that at least gave them cushion to negotiate or find alternative source for them. Secondly, China has a lot of dry powder in terms of policy and monetary policy in hand, still can be implemented in China to help their own domestic economy if shall needed be. So those are in a very unique situation for the country to be actually stable. If you see OECD's prediction was China to grow at 4.4% and next year 4.3% if the scenario continues. That shows China growing slowly, but growing, not, sharply collapsing.
Thank you so much. That's Head of International at KraneShares, Xiaolin Chen.